Before we begin this podcast, we'd like to remind listeners that Netwealth is licensed to provide general financial product advice only, and that this podcast isn't tailored to any particular person's objectives, financial situation, or needs. Before a listener acts on any advice in this podcast, they need to think about whether it's appropriate for their circumstances or their clients, and consider the product disclosure statement for any proposed investment, and also seek any professional advice they need. Netwealth Investments Limited is the issuer of Netwealth's financial products. For Netwealth's financial services guide, contact details, and other information about our products and services, you can visit our website at netwealth.com.au. Today's podcast guest is a financial product issuer. Netwealth and the guest have a commercial arrangement that enables investment in products managed by the guest through Netwealth's platform. Under that arrangement, Netwealth may receive fees from the podcast guest. More information about the fees Netwealth receives is provided in our financial services guide, which is available on our website or by contacting us. Welcome to the Netwealth Portfolio Construction Podcast, brought to you by the Netwealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.
Welcome to the Netwealth Portfolio Construction Podcast series. My name is Paul O'Connor and I'm the Head of Investment Management and Research at Netwealth. And in my role here, myself and my team manage and govern the investments that we make available to you through the Netwealth investment platforms. Today we have Charlie Lanchester, Managing Director and Head of the Blackrock Australian Fundamental Equity Team. Welcome, Charlie. Blackrock have a number of managed funds available on the Netwealth platform across numerous asset classes, and we have Charlie's active Australian equities fund on both the superannuation and non-superannuation investment menu. I thought naturally, since we've got Charlie here today, we'd focus on Australian equities and certainly be interested in your thoughts on, the economy and then also investment opportunities that you're seeing and discovering that are available on the stock exchange. So starting at a macroeconomic level, many commentators are talking about how late cycle we are in the economic cycle and are talking about GDP growth moderating, corporate earnings weakening. What are your thoughts on where the Australian economy is at the moment?
Yeah, well, look, we've obviously been a very lucky economy, if you like. If you look around at the rest of the world, I think it's now 28 years of uninterrupted economic growth. And many people in the market today have never seen a proper downturn or recession. I started working initially in the industry in 1992, which was in London actually, but in the midst of a recession when it was incredibly hard to get a job. And so I do recall what it can be like in those times. And we as a team at Blackrock are cautious, particularly around the domestic economy here in Australia. I think the housing market coming off, that the effects of that have yet to be fully felt. We've seen some pullback in spending by the consumer, but not a lot. And we personally, we think there will be more because the wealth effect of house prices going up consistently will take time to reverse. And I think, quite honestly, the banks have lent a lot of money to many people who don't own that much money themselves. And if there's any sort of dislocation, I think there will be some form of bad debt cycle in the banking system. And the banks are at record bad debts right now, record low bad debts. But I think if there was any tick up in unemployment, and we're going to see construction activity come off, we haven't seen the full effects of that yet. But if we see a tick up in unemployment, we will see some form of bad debt cycle, which will affect the economy. So we are reasonably cautious. That said, we're an active equity participant and we are still finding very good ideas within the Australian market.
No, interesting there. And I guess house prices appear to have moderated a little bit, as in the fall in house prices. And potentially, I think we're already starting to see an uptick again in some of the residential, developers in Melbourne and that getting back out there. But I think given the impact that it's had on the savings rate, and I think I'm with you there, that I think there's still a lot of caution out there in the economy. And are we actually seeing a genuine uptick in growth, or are we continually grinding down slowly, as has been sort of shown by, I think, the recent RBA cuts there that we've seen? The results of the federal election certainly surprised most people, and the market's reaction was extremely positive. What's your view?
Look, it was a surprise, as elections around the world seem to be increasingly surprising based on polls that don't seem to work. But I think, there clearly has been some confidence restored to the economy. There were some major changes the Labor Party were talking about bringing in, which at a time of economic uncertainty, I think would have been potentially quite challenging. So certainly there's been some relief in the market. I think that's a reason why house prices might have stabilised in recent times. But at the same time, the RBA has had a massive change and has reduced rates twice in the last 2 meetings. So they're obviously concerned about the outlook as well. So I think the big issues have not gone away, and that really is around the indebtedness of the consumer here in Australia. That's not changed by the election. I think we probably have a more solid base. It will be interesting to see whether we get a fiscal response to go with the lowering of interest rates. One of the strengths that Australia has, and certainly has been helped by the strong iron ore price of the last year or two, is a reasonably strong fiscal position within government. And so whilst we talk about budget surpluses, and there seems to be a great deal of talk about that, investment back into business in terms of fixed asset investment and fiscal spend, to me, seems to make sense when interest rates are at such low marks. If people are willing to lend you money at such low levels for very long periods of time, as a government, why wouldn't you take effect of that to kickstart your economy? So,
yeah, it's amazing in terms of the way bonds can still be sold on a negative yield offshore, and the Australian 10-year bond rate is down to about 1.3%. So you start to question what is going on over the medium to longer term there. What was your view on the proposed change to the franking credits of the Labor Party? Do you think that was an equitable proposal they had put forward, or?
It's a hot potato. I was caught commentating a little bit on this in a briefing we did earlier in the year, and Jeff Wilson's actually a good friend of mine. And
Jeff was certainly a vocal critic there of the ALP.
Yeah. So I've got to be very careful what I say in case Jeff's listening to this podcast. But he actually took me aside and really explained to me in a lot of detail, because it was quite complicated, I think, just how the changes were going to affect various groups of people. And what I found odd and didn't really agree with was it was targeting effectively. It's a franking credit that they weren't getting rid of it. They were just targeting one set of investors and reducing their ability to access that franking credit. But whilst keeping a whole range, most of the market was still able to access that. If you're in an industry fund or in a different tax-paying environment, you had access to that franking credit. Just self-managed super funds who were gaining credits were being arbitrarily ruled against. So I think it was a good thing that Labor have now scrapped that policy because it was, I think, a not particularly well thought through change, albeit you can argue that changes may need to be made to the broader tax system.
Turning our attention to the ASX, I'm guessing from your earlier comments there around, house prices and the Australian banks that you probably have a neutral to underweight to the major banks. What's your view on the banks over the medium term?
Yeah, well, look, actually, we've designed a product, and it was a great thing to come to Blackrock 4 years ago now and design an equity fund with a blank sheet of paper that I really believed in and can invest my own money in. And one of the things that we did as part of that design was to exclude banks from our universe. The fund that we're running is very much aimed at the retail market. And my thought really was that the last thing that a retail investor needed was for me to buy them another bank share. They probably own a lot of them directly. They may own an investment property, which is the same trade. And really, I do think Australian investors are overexposed to the banking sector. So we've excluded them from our fund. It's their Blackrock Concentrated Industrial Share Fund X5. 4 of those 5 are the major banks.
So you have none of the second-tier banks either?
No, we don't. So I do have, as I probably can guess, I've alluded to, a somewhat negative view on the banks. I mean, they've had a very, very good run over the last 20 years. They have, increasingly leveraged their balance sheets to invest, to residential Australian property. I mean, NAB used to have a UK business, a US business. ANZ had an Asian strategy. They have all pulled back when the regulations changed and made residential mortgages more profitable. They concentrated their books of business, which I guess was understandable in terms of meeting their profit guidance on residential mortgages, and that's a large portion of all of their profits now. And, they are very similar. And so to invest, if you look at our index in Australia, almost a quarter of your money effectively in one stock, to me, does not make sense. The concentration risk is just too great. And I think the outlook is weak to poor. Bad debts are at all-time lows. When they stress test the portfolios, they look over the last 20 years, they sort of take the view they've never lost money on a mortgage. My view is they've actually lent a lot of money to a number of investors in particular on interest-only loans that have no ability to switch to principal and interest repayments. And I think there's risk in the system. We have the most indebted consumer society anywhere in the world, and it's all based around property.
Oh, interesting. Interesting and perhaps sanguine comments there, Charlie. What about commodities? What's your view over the short to medium term there? I think it was a bit of a surprise, the returns they've generated over the last 12 to 18 month period, the uptick in them. And I guess in my view and career there, I'm sort of like, how do you even pick a commodity and a commodity price, let alone the corporate, and whether the corporate can capture that value or lack thereof in the commodity?
I could not agree more. And I'm going to get out of this one again beautifully because, again, with a blank sheet of paper, we have chosen to avoid commodity stocks for that exact reason. I think, the skill base required to pick the direction of commodity prices, who could have predicted the dam in South America collapsing and the iron ore price going through the roof? This is not something I can do. And so, again, when you start from scratch, you can be very honest about that. And this is why it's the concentrated industrial share fund. When we say industrial, it means everything X resources. So we don't invest in resources for that exact reason. Very hard to pick commodity prices. That said, it may well have a place in people's portfolios. My advice would be to go and find a very good manager who looks at these stocks on a global basis, not just a long-only Aussie equity manager who might look at BHP and Rio and a few others. This is a global sector driven by global commodity prices. You should find a global manager to manage your assets in that space. That said, we do have exposure because we think there's some positive signs coming through still in that sector to the mining service companies. A lot of CapEx has been really cut back hard in that sector. And it's been driven by shareholders like the big funds like Blackrock in London, actually, who we speak to, forcing companies really to focus on paying dividends and cutting back on their CapEx programs over the last 5 years. And these commodities run out. And so we like companies like Worley, which obviously focused on the oil and gas sectors in particular, and chemicals now with their latest acquisition. We like Monadelphous, we like NRW. These sort of mining service companies, we think CapEx is starting to come back into that sector, and that's how we can play it.
Before we bring you the second part of this chat, a little bit about who we are. Netwealth is an ASX-listed company established to help Australians take control of their financial futures. With a wide range of super and investment accounts, a huge variety of investment options and market-leading online tools, we can help you manage your wealth your way. Partner with us to see wealth differently and discover a brighter future. Visit the Netwealth website to learn more and get the PDS, which you should read before making a decision. Products issued by Netwealth Investments Limited.
And it seems to be probably a safer way to play it through then and a less volatile way to go down the mining service company than the actual miner as well there. But I often think too that Australian investors have such the Australian economy has such a strong correlation to the commodity prices that from a simple diversification perspective, it makes sense to have an underweight exposure because our whole economy has a large overweight exposure to it. So in terms of building portfolios there. Outside mining services, what other opportunities are you seeing on the ASX at the moment? Any strong growth themes that you're looking into and industry developments that you can make some comment on, Charlie?
Yeah, look, there's definitely, I think we're very focused on picking long-term structural themes. And technology is something that we have been thinking about and talking about since we started the fund. And we've owned stocks like Aconex in the past, which was taken over. And we currently own two stocks, Bravura and Gentrack, a New Zealand-based software as a service business that we think are still reasonably priced. Now, long term, broadly, I think that the ASX is going to have a much larger technology focus. If you look back maybe 10 or 15 years, the healthcare sector was maybe 1 or 2% of our index. And this is the problem I have with indexes sometimes. They're backward looking. They tell you the companies have done well over the last 10 or 15 years. So the healthcare sector is now over 10% of our index, driven by the success of CSL, Cochlear, ResMed, Sonic Healthcare. Fantastic Australian companies that have done well on the global stage. So we have a view that there will be a much larger tech sector and that you need to have some exposure to it, I think, over the next decade. That said, we also think that there's a bit of a tech bubble going on. And in fact, if you look at the valuations of some of the Aussie tech companies, just over the last 12 months, they have taken off. And I was around in Australia in 99, 2000. There's definitely elements of certainly feeling similar to those times in the
dot-com bubble.
Yeah, look, I mean, the businesses, I think, have stronger business models, but some of the valuation metrics being used remind me of the exuberance that was around back then. And, it just seems that some of our stocks now, the WACs, I think some people call them the WiseTechs, Appen, Altium, Xeros. Some of these are very good companies, but they are now on up to sort of 20 times EV to sales multiples, which is significantly higher than many of the FANGs even over in the US. So I think there's a little over exuberance, but some of those businesses will be around in 10 years' time, and I think some of them will be a lot bigger than they currently are.
What about in terms of technology and how it's impacting on asset management? And how's that going to help you going forward in terms of finding stocks generating outperformance for investors over time? Have you got any comments there about where Blackrock and your team's at?
Yeah, look, absolutely. I think every business is being affected and disrupted by technology, and fund management is not going to be unaffected. And one of my reasons for joining Blackrock 4 years ago now was a recognition. I think that over the next decade, fund management businesses that have scale and the ability to invest in technology in all of its various forms will have an advantage on the small boutique sitting in an office with one or two analysts and sort of really substandard systems. So I think that this is increasingly playing out. We have a platform at Blackrock called Aladdin, which we sell to other fund managers, very large fund managers around the world. It has incredible risk analysis of what sits within our portfolio. All of our trading sits there. It means all of our compliance is 100% up to date. It's an amazing platform, which effectively we get in our fund to use for free. On top of that, BlackRock on the active equity side is also investing heavily in the use of data scientists to try and come up with ways of using, artificial intelligence, various sources of data that we as active managers can add to our investment process. And look, that is work in progress. I'm actually working with the team over in Hong Kong at the moment on a management quality scoring system where we're scraping the web, Glassdoor comments from various employees that we can then use when we walk into management meetings and predict potential changes in how employees are viewing their businesses. So we're working on this stuff. It's early days. Hopefully next time I come and talk to you, I can give you some concrete examples of how we've added huge amounts of alpha. But I definitely think, for a company like BlackRock with the scale that we have, this is going to be a real advantage for us over the next 10 years.
Yeah, it certainly makes sense to me. And in all of the different fund managers that I meet out there in the market, I guess my thinking is in this day and age, it's not finding information, it's efficiently trawling through the information and getting to what really is meaningful and impacting on a stock price. So the more a fund manager can invest in technology to grab all that information and to essentially make the analysts and the portfolio managers like yourself more efficient in where to spend your time, certainly makes rational sense to me. And that does require a large amount of capital investment there. So I would fully agree with your views there, Charlie. Just changing tack a little, how do you think investors should be thinking about the equity allocation in their portfolios? And I guess given the ongoing rise of passive investing, what active investment styles do you believe are complementary to passive?
Yeah, look, I think that both active and passive have a place in people's portfolios, depending on the market you're in, the stage of life you're in, perhaps. And I think, we go out and sell our fund alongside passive. And I think it's a great offering because...
Well, I see a lot of our clients blending both active and passive strategies and trying to put them together in portfolios.
Yeah, exactly. And you can do that because... and we are really literally at one end of the bell curve and passives at the other. And I think that the managers that are going to be squeezed are the ones that sit in the middle that are semi-passive. I think there's still a lot of long-only active managers in Australia who are plus or minus 2 or 3% versus all the index weights in the market. Now, that I think just doesn't really justify some of the fees that are being charged. You're better off just going purely passive and paying a very low fee, right up to what we do, which is using all of the advantages that we have at Blackrock to build, really a 20 to 30 stock portfolio. The top 10 stocks make up 50 to 60% of the fund. We are having a go. We are index unaware, but it's, it will be a part of your portfolio. And there will be times when we significantly differ from the benchmark, and you've got to be able to put up with that, or enjoy it, depending whether it's positive or negative. But it fits nicely within a spread of investments, and it will suit some people more than others. So depending who you are and what stage of life you're at, as I said at the start. So I think that's where you want to be, one end or the other. I think the stuff in the middle, it becomes quite hard for active managers.
Yeah, no, it's certainly an observation we've noted, and particularly with the number of asset management businesses that have closed their active Australian equities over the last 12 months there. But I tend to think another point that is missed in why investors should be considering active management is that it's not only about generating a return, it's about risk management as well, and the ability to move pending, what the outlook is or what's impacting on the stock prices at the end of the day. So to me, it's both about risk and return, I think, which is a prevalent point for our listeners there. So finally, maybe, can you give us a couple of your investment rules that you've learnt over the years, and maybe even rules you learnt as a young fella before you got into the industry there, of professional investment management, and rules that you also apply in your personal life there, that you may also apply in the way you manage the portfolio as well?
Yeah, look, that's quite a broad-ranging question. I've been lucky enough to be in this industry since I was 21. So I came straight out of uni and worked at Schroders in London on their graduate training scheme. So I've been very privileged to be a fund manager pretty much my whole career. And I think, humility, curiosity, doing the right thing by your clients, these are some of the fundamental tenets of what makes me a fund manager. I think your ability to realise when you've made a mistake and cut a position, even though it's down, is one of the core skills. Very hard to do. Psychologically, people love to hold stocks and try and get it back to the level they bought them at. That's almost always the wrong thing to do.
And if you've spent so much time looking at a corporate, meeting with them and looking at the industry, I can understand how it would be easy to fall in love with that stock and try and ride through.
Yes, exactly. So you've got to insulate yourself from that as much as you can. But it's a wonderful job. I mean, I think what has driven me to enjoy it so much is curiosity. I think when I interview people for jobs in the industry, I really look towards that mind that just wants to discover something new, because you're constantly turning over stones along the way, and it's just such a privilege to meet the people that we get to meet who run these companies. Given the fact that we're managing other people's assets, it gives us that access. It's a real privilege. It's that part of the job that I love probably the most.
Yeah, I guess you would be privy to a lot of insights and a lot of ongoing discussion about trends and where industries are going and where the economy is heading, and how a corporate is being, I guess, directed through that by its CEO and the board there. So, no, very interesting there, Charlie's. Finally, in conclusion there, I'd like to thank you for coming along today and participating in the podcast series there. And all the best for the journey ahead in navigating the markets and in managing your portfolio.
Thanks very much for having me.
Thanks for listening to this episode of the NetWealth Portfolio Construction Podcast Series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.